Okay, let's get into it. We're doing our deep dive on the NextPlat first quarter 2025 earnings call.
Right.
We've got the transcript, the press release, basically everything we need to sift through and figure out what's really going on.
Yeah, definitely a lot to unpack this quarter.
So the plan is hit the key financials, get into what management said about, the challenges, the opportunities, especially e-commerce and healthcare. Then look at the strategy and cover those shareholder questions at the end.
Sounds like a plan. It was definitely a quarter showing some clear headwinds, but they did try to balance that by pointing to areas of progress and, how they're trying to navigate it all.
Okay.
We should probably start with the numbers, just a quick overview.
Yeah, good idea. Let's hit that Q1 2025 snapshot first. So total revenue landed around $14.5 million.
Right. And that's quite a drop compared to the $17.5 million they did in the same period last year.
Yeah, noticeable. And that drop hit the gross profit margin too, right? That was down as well.
It was, yeah. Lower revenue, lower margin.
Okay, so top line pressure, margin pressure. But interestingly, overall operational costs actually went down.
Correct. They pointed specifically to getting rid of several non-recurring expenses. That was the main driver there.
Makes sense. And how did they end the quarter cash-wise?
Pretty decent, actually. About $17.7 million in cash on hand.
Okay, so quick summary. Revenue and margin, challenging year over year, but they managed costs down and kept a solid cash balance.
That's the high-level picture, yeah. A bit of a mixed bag, really.
All right, let's dig into the why. That revenue dropped $3 million less than last year. Where did that primarily come from?
Well, a big chunk of it was on the healthcare side. It really came down to shifts in their 340B pharmacy service agreements.
Okay, remind us quickly, 340B.
Sure. It's a government program, lets certain hospitals and clinics buy outpatient drugs cheaper. Pharmacies like NextPlat can partner with them to dispense these drugs, and typically those deals are higher margin.
Got it. So what happened with those agreements?
There were several changes. Some partners just transitioned away. One facility decided to open its own pharmacy in-house.
Okay.
And another partner actually left the 340B program entirely. So kind of multiple hits there.
Right. So losing some key higher margin partnerships. Was there anything else impacting healthcare revenue?
Yeah, they also mentioned just a general decline in prescription volume overall. And they linked that to changes in provider relationships and also shifts in patient flow, maybe insurance network changes, things like that.
Okay, so partner volatility, patient flow issues hitting healthcare hard.
Yeah.
What about the e-commerce side? Did that pick up any slack?
E-commerce revenue did go up, actually. That was mainly driven by growth in recurring airtime revenue, think satellite comm services.
Right.
And also the contribution from that outfitter acquisition they made in 2024.
Okay, so services and the acquisition helped.
Yeah, but that growth was kind of offset because hardware sales within e-commerce went down.
Ah, okay. So good on services, weaker on the product side.
Correct.
Now back to the gross profit margin decrease. What drove that lower?
Well, in healthcare, it was pretty direct, less of that high margin 340B contract revenue we just talked about.
Makes sense.
And then on the e-commerce side, it was sort of twofold. An airtime contract expired at the end of 24, which meant new costs hitting them in 2025.
Right.
And they also gave some temporary rate cuts to customers who'd been affected by service disruptions. So a couple of hits there.
Got it. Less high margin business plus some new costs and discounts. Now, you mentioned operational costs were down. What specific things did they get rid of?
They called out a few specific non-recurring items. One was an impairment loss, basically writing down the value of an asset. In this case, a right-of-use asset, probably related to leased equipment no longer in use.
Okay.
They also didn't have the same level of fully vested stock-based compensation hitting the books this quarter. And those legal and consulting fees from the Progressive Care merger, those were way down now that the deal's done. Removing those kinds of one-offs helped the cost line.
Okay, let's pull back a bit and look at the segments more strategically, starting with healthcare. What are the big picture challenges they're dealing with, just industry-wide?
Well, like pretty much all independent pharmacies, they're facing, significant pressure on drug pricing and especially on payer reimbursements.
Right.
Insurers, PBMs, they're always squeezing what they pay pharmacies. It's just a tough environment out there.
Definitely. But they did call out some positives in healthcare, didn't they?
They did, yeah. A definite bright spot was receiving a pretty substantial performance bonus from one of their payers.
Oh, interesting. Based on what?
Based on hitting specific quality and adherence measures in some kind of enhanced program. It shows that, despite the tough reimbursement climate, they seem to be executing well on the patient care side.
That's good to hear. And are they trying to replace those 340B contracts they lost?
Absolutely. That seems to be a major focus. They mention signing several new 340B pharmacy service agreements during the quarter.
Yeah.
And that's really central to their strategy now because, like we said, those deals are expected to bring in revenue growth and, importantly, much better margins than just, traditional retail pharmacy.
Right. How else are they trying to manage costs, specifically within healthcare?
They talked about actively working on things like optimizing their delivery process, just making it more efficient to get meds to patients, and also trying to renegotiate contracts with their vendors, trying to get better terms there. Standard stuff, but important.
And it sounds like the whole strategic direction for healthcare is kind of under the microscope, too.
Totally. Management, the board, they're evaluating strategic alternatives for the healthcare segment, trying to diversify.
Like what kind of alternative?
Could be offering additional services, maybe setting up joint ventures or other sort of collaborative structures. They think these could offer operational synergies and growth potential at decent margins.
So let's focus on just filling prescriptions over the counter.
Exactly. The call really highlighted a shift away from relying so heavily on that traditional retail model and moving towards locking in these longer-term contracts and developing new service lines.
Okay, shifting gears to e-commerce. They mentioned global growth on the communications side.
Yeah, they seem pretty positive about that. Continued strong global growth driven by signing new contracts for their satellite communication services.
And that provides high-margin recurring revenue.
That's the key. High-margin recurring airtime revenue.
And crucially, that part of the business isn't affected by tariffs, is it?
Correct. They made a point of saying that recurring airtime revenue is not subject to tariffs. And actually, that specific revenue stream grew 51% to record levels this quarter.
Wow, 51%.
Yeah, boosted by growth in their IoT Internet of Things sales, plus the impact from the Outfitter acquisition.
Okay, good news there. But now let's talk about the elephant in the room for e-commerce. Tariffs. This sounded like a really big deal.
It is, yeah. Management was very blunt about it. The current tariffs, especially on goods going into China, have basically made launching their Florida Sunshine products there economically unworkable for now.
So that launch is on hold?
It's paused, yeah. They did say they see some signs of constructive discussions happening that might lead to a better outcome, potentially letting them restart those plans. But for now, it's stalled.
But what's the impact if those tariffs don't get better?
Well, that's the major risk they flagged. If the current tariff levels stick around, they expect it will basically delay or maybe even completely eliminate the big chunk of growth and revenue they were counting on from their e-commerce development programs like Florida Sunshine in late 2025 and into 2026.
Wow. So that future growth plan is seriously threatened.
Yes. And they explicitly stated this situation creates substantial pressure against hitting a key financial goal.
Which was?
Reaching cash neutrality from operations by 2026. That was the target. And these tariffs are making that target much, much harder to hit.
Okay, that's significant. So if China's tough, are they looking elsewhere for Florida Sunshine?
They are. Actively exploring other markets, U.S., other international spots. They mentioned they've already set up a specific website and Amazon stores for a planned UK rollout.
Okay.
And they're even looking at potentially producing the products in other countries to get around tariffs that way. So while China's a setback, they are trying to pivot. They've framed the ongoing tariff talks as, at least a step towards maybe finding a resolution.
Are other parts of their e-commerce business doing okay avoiding these tariffs?
Yes, their OPCO products in China seem to be making steady progress. Because those aren't made in the U.S., they aren't hit by the same tariffs.
Oh, okay.
They mentioned inventory arriving recently and starting a small test selling those products in actual retail stores in China, not just online.
What about the Outfitter business they bought? How's that weathering things?
The U.S. side of Outfitter does see some tariff impact on hardware, but a lot of their customers are state and local governments.
Right.
And management's view is those clients tend to be less sensitive to small price increases from tariffs compared to, say, regular consumers. So a bit more resilient there. Overall, they see their diversified mix of businesses as a strength right now.
Did they mention seeing opportunities because of all this market uncertainty?
He did, yeah.
Yeah.
They believe the current challenging environment might actually open up opportunities both for organic growth, just expanding what they have, and potentially non-organic growth, like acquisitions, especially targeting providers who maybe lack NextPlate scale and are struggling more in this market.
Gotcha. And just quickly, any update on their Opto Animal Health product?
Still waiting on Chinese regulatory approval. It's been delayed. They're now conservatively expecting that sometime in Q4 this year.
Okay.
And once they get the green light, they figure initial sales could start maybe 12 weeks after that.
All right. So overall, management seems to be saying, look, challenges are real, but there's underlying value and we're working on it.
That was the gist, yeah. Emphasizing they're actively tackling the issues and trying to keep investors in the loop.
Okay, let's try to synthesize this for listeners. From an investor perspective, what are the really key takeaways here?
Well, I think the big picture is clear. NextPlate is definitely operating in a tough environment. You've got significant external pressures, namely those tariffs hitting e-commerce hard,
right,
and the ongoing healthcare reimbursement squeeze. But critically, management isn't just, sitting back. They're actively cutting costs. They're making that strategic shift in healthcare away from pure retail towards contracts. And maybe most importantly, they're exploring these significant strategic alternatives for the business as a whole.
And that tariff issue, you emphasize how critical it is. Why does it matter so much for their future?
Because management was so direct about it. It's not just a small bump. They used the word material impact on future growth they were banking on, particularly for late 25 and into 26.
Then that links directly to the cash goal.
Exactly. It puts substantial pressure on reaching that 2026 cash neutrality goal. Getting to a point where the business funds itself without needing more cash infusions, tariffs make that a lot harder if they don't get resolved favorably.
So big headwinds from tariffs and healthcare pressure, but you wouldn't say it's all negative.
No, definitely not. That strong growth in recurring airtime revenue is a real positive high margin, not tariff affected. Getting that healthcare performance bonus, despite payment pressures, shows good operational execution.
Right.
Signing new 340B contracts is vital for their healthcare pivot. And, segments like OPCO are still moving forward because they aren't subject to tariffs. So there are bright spots.
And this strategic evaluation process they mentioned, what should listeners read into that?
Well, the fact that the board is openly exploring options like selling parts of the business, merging assets, or finding major strategic partners, it tells you they're considering pretty fundamental changes.
Because the current environment is so tough.
Precisely. It signals they're looking at potentially transformative options to navigate these headwinds and try to unlock value for shareholders. It's a really key development mentioned on the call.
Okay. They also took some shareholder questions. First one was about share buybacks. Why haven't they done any?
Right. Management gave a couple of reasons. One, standard blackout periods around earnings when they just can't trade. But more significantly, they said legal counsel advised they can't trade when they possess material non-public information. And they specifically stated that their recent comments about the potential significant impact of tariffs counted as that kind of information.
Okay. So the tariff uncertainty itself prevented buybacks.
That's what they indicated, yes. They said buybacks are still an option. They evaluate against other cash uses, but they have to follow SEC rules, and the tariff situation complicated things.
Makes sense. There was also a question about a director resigning.
Yeah. A director who had ties to the previous Progressive Care entity resigned. Management said they couldn't speak to the director's personal reasons, but they were clear it was not due to any disagreement with NextPlate.
Okay. Are they replacing that director?
They said they'll consider adding another qualified independent director, but it's not actually required by their current bylaws. So maybe not right now.
And what about NASDAQ Q compliance? Their stock price has been low.
Yeah, they addressed the minimum bid price requirement. They explained the process. You get an initial 6 months to get the price back up over $1.
Right.
And potentially another 6 months after that if you meet other criteria. Their strategy is basically try to improve financial results, push forward with those strategic alternatives, which could obviously impact the share price, and just keep communicating clearly with investors. They believe that combination can help address the issue over time.
Okay. And finally, any update on ongoing lawsuits?
Nope, standard procedure there. Management stated they couldn't comment on any ongoing litigation during the call.
All right. Now let's pivot to our totally hypothetical, absolutely not financial advice segment.
The fun part. Disclaimer first. Seriously, this is just brainstorming. based only on the call commentary. It's for illustration, not investment advice. Do not trade based on this.
Couldn't say it better myself.
Okay.
Okay, speculative idea number 1.
Okay, so putting on the imaginary hedge fund analyst hat, idea 1 focuses on that strategic review they kept mentioning.
Right, the exploring options part.
Exactly. If the board is openly saying they might sell or merge assets, that creates potential for a big stock price move. Could be up if there's a great deal, or down if, nothing happens and the core issues remain.
So basically betting on increased volatility.
That's the angle. One purely hypothetical trade idea based only on that strategic review statement might be to buy options that profit from a large price swing regardless of direction.
Like a straddle or strangle.
Precisely. Buying both out-of-the-money calls and puts, maybe expiring sometime after you think an announcement might happen. The bet is that the market isn't fully pricing in how much the stock could move on that kind of news, positive or negative. High risk, potentially high reward event play.
Okay. Betting on a big reaction, up or down, to whatever comes out of the strategic review. What's another angle, another hypothetical idea?
Idea 2 plays on the contrast between the segments and that massive tariff issue. Management was crystal clear. Tariffs are a material headwind, pressuring growth, pressuring that 2026 cash goal.
Yeah.
But they also talked up growth areas like domestic IoT airtime, no tariffs there, and potential improvements in healthcare, like that quality bonus.
So this idea involves betting against the tariff hit parts, but maybe for the areas doing better.
Sort of, but framed as a relative value play against the market. So another highly speculative concept. You could hypothetically short shares of NextPlat betting. The price goes down, specifically citing the material tariff impact and the pressure on that key 2026 goal as the reason. But simultaneously, you could go long a basket of other small cap stocks, maybe ones exposed to domestic IoT growth, or maybe healthcare service companies benefiting from those quality-based payment shifts they mentioned.
Ah, I see. So trying to capture the specific NextPlat headwinds while still having exposure to the positive trends they operate in.
Exactly. You're trying to isolate the company's specific negatives, tariffs, from the broader sector positives they also touched upon. It's trying to be smarter than just a simple stock up or stock down bet based purely on the call's narrative.
Interesting thought process. But again,
totally hypothetical, purely illustrative examples of how someone might interpret the call's commentary into a trade idea. Extremely speculative, huge risks involved. Absolutely not financial advice. Please do your own research or talk to a professional.
Absolutely. Take that disclaimer very seriously. Okay, so wrapping up this deep dive, it was definitely a challenging Q1 for NextPlat. You've got these significant external hits tariffs messing with e-commerce growth plans, those ongoing healthcare reimbursement pressures.
For sure. Big headwinds. But the call also showed, pockets of strength. That recurring airtime revenue growth is solid. Operational wins like the healthcare bonus are good signs, and management is taking action cost controls, pivoting the healthcare model.
And crucially, undertaking that strategic review.
Yeah, that feels like the big one to watch. Given the potential material impact of tariffs on their future growth and that cash neutrality goal, what comes out of that strategic review could be really significant.
It certainly signals they're open to big changes to deal with this tough environment.
Definitely seems that way.
Okay. If you, the listener, have more questions for NextPlat based on the call, they provided their investor relations email, investors@nextcloud.com.
And the IR contact mentioned was Michael Klipman at mikemwgco.net.
And one last time.
Everything we discussed today is purely for informational purposes. It is absolutely not financial advice.
So as you think about NextPlat trying to navigate all this, here's a final thought to mull over. Considering just how significant these external challenges are, the tariffs, the healthcare payment shifts, how much could a major strategic partnership, or maybe even a sale of some part of the business, fundamentally change their ability to actually overcome these hurdles and maybe even find a stronger path forward? Something to think about.